Welcome, everyone, to another exciting episode of the YouTube show and podcast, None of Our Businesses, where we talk about the week's news in current events, finance, accounting, maybe none of those things, but whatever we talk about, it's always from the perspective of accountants. And today you've got three accountants. I'm Ty Carr, and with me is Charlie Zygmunt.
Hi, everybody.
And Tammy Hess.
Hello, everyone.
Here's what we're talking about today. Cannabis and unions. From Accounting Today, Excel macro crackdown and other interesting accounting tech updates. Another installment in my series on craft spirits finance, why people first when considering your accounting needs. Then we're going to talk about using LLCs to stiff local governments on real property taxes. And finally, Disney price hikes are not just inflation. All right, well, let's kick it off with Charlie.
All right, so I've got an article we can talk about from The Guardian called Booming U.S. Cannabis Industry Seen as Fertile Grounds for Union Expansion. And so, what's going on is, of course, as we've talked about on this podcast before, cannabis legislation and legalization has kind of been spreading throughout the U.S. And so it's created this booming industry. And, up until now, there hasn't been much interest in there being a union in that industry, or at least not in a way that was organized that actually became anything. But it looks like now in Chicago, as an example, there are a bunch of dispensaries that have been unionizing and have been promoting their union contract to kind of, get people to join into their operation and whatnot. And the contract, what it does is it permits customers, kind of its main points are that it permits customers to tip workers, and it guarantees annual raises, seniority rights, and 40 hours a week to full-time staff. So those are kind of some of the selling points of the unionization in that dispensary. And there's a person named Alex Suarez who gave a comment on it that said, basically, we're trying to make these careers for the long term so that it's not just a big turnover establishment. And, I kind of wanted to get your guys' take on a couple of things. It's like, one, do you think that Oregon will become a unionized cannabis state? And then two, what do you think would change in the industry if that were to happen from your perspective? Just because, it's something that hasn't been done here up until now. And so I want to get you guys' take on it.
I think that unions could have the ancillary effect of helping professionalize the industry a little bit in terms of, because there's still a lot of things that go on where cannabis companies are not putting all of their workers on payroll like they should, or, maybe not having the right insurance and, things like that I think maybe could be cleaned up by cannabis companies being subject to unions. I mean, that's a pretty extreme and harsh way to clean up some of those issues. So I wouldn't want that as the operator in those spaces. But yeah, given that it's still a little bit Wild Westy in that industry, that right now, I think has that kind of ancillary benefit.
Yeah, I was thinking about that too, Ty, because I always go to the reasons why, someone wants to, join a union or create a union in their current establishments and kind of the pros and cons of those types of things. And that is the kind of thing that stood out to me, is it is the Wild West still in terms of the cannabis. And I do think that is probably a good benefit for some employees, especially in terms of whether it is they're getting paid in cash off the payroll, they're not getting taxes, but they do owe taxes, they're not getting the benefits and the health benefits and all those kind of things, that this does kind of force that to happen, right? And so that could be a good result of that. But yeah, it is a little bit of an extreme way to do that. It would have probably been better for operators to have those things in place, so it's not that the reasoning of a union or having a union be created to actually push those things to account and treat your employees properly shouldn't have been the need, to do that they should have done that just because it's best business practice. But yeah, I thought it was a pretty interesting kind of thing. And I think that just like anything else, if you see success where those things are happening, then usually that it is kind of the things that will come. You'll start seeing probably this pop up in different areas or in different states and things of that nature.
No, that makes a lot of sense. And yeah, I think it's a good to kind of just remind workers in those fields that, the law still applies to your employer in that industry. And so if you're working and not getting, payroll taxes taken out of your check, for example, that's a good chance to kind of stop and take, side of that business. And a union would help ensure that, but you can do that as well by just looking at your pay stub as you work at a dispensary. So yeah, always good advice. Do you have another article we can talk about, Tammy?
I do. So Accounting Today posted an article regarding some tech news that people should be aware of. And as we have come to expect, things in the tech world are always changing, and it can be difficult to keep up with all the changes or even be aware of things to come. So I thought I would share some of the items that was noted on the article. One, we need to be prepared for the Excel macro crackdown. There has actually been a lot of back and forth on this item. Microsoft had previously stated that Excel files that contain macros will be blocked if downloaded from the internet. But then last month, they said that they were pulling back on that decision. However, it was reported recently that blocking Excel documents with macros is still on the horizon. It's just not in the immediate future. So keep an eye out for that. Or continue to keep an eye out for that, I suppose. A second one was, this may not come as a surprise, but a recent survey stated that employees are dissatisfied with the technology in the workplace and have even considered quitting over it. Some employees say that they pay out of their own pockets to work around their poor technology. So something businesses and should also just be aware of, companies should be aware of. Number three, expecting to use G Suite for free. Well, at the end of June, Google moved to a subscription model, which was basically something that was once free will cost now between $6 to $18 per month per user. So something to keep an eye out for that. Number four, Google has announced a new program, Chrome OS Flex, that can extend the life of older Macs or PCs with a free download. This may be useful for folks that aren't quite ready to invest in a new computer. So that could be something that's worthwhile if you trust downloads these days. Number five, Guava, which is a banking and networking platform that supports and celebrates Black businesses, raised $2.4 million. And I was curious because I hadn't actually heard of that company before, but in looking at their website, they are more than just a financial institution. It's a great way to connect, partner, and learn with members of the community. And the last one that I wanted to cover was from Google, which seems to have a lot of mentions on this list. But have you been longing for Google Maps to have more features? Well, they've developed a few new ones for businesses that allow them to provide more information, such as store location, new analytics, and the ability to connect with the consumer. So I don't know if there's anything that surprised you on this list or if there's any ones in the articles that I might have skipped over, but I thought we would kind of discuss that.
Yeah, I mean, I can talk for a moment about, the one that, of course, piqued my interest would be the Excel one. And so, I mean, I think I generally agree with what they're saying and what the move is, that files downloaded from the internet that have macros on them can be dangerous and that the users often don't understand what they're actually getting into when they're downloading this thing. And so it's good to have those controls in place. I think disabling it completely would be a mistake because it removes a lot of functionality. And because I think even if because I know what happens in a lot of the time is it's that if you're trying to implement these solutions and you're using a tool online where you might download a file, another way people do that is they'll post the code they used for something, and then you'll put that code in your workbook. And so unless you're going to disable the feature completely, then the issue that you're trying to solve would still be there, even if you make it so that they can't use files that they get from the internet, because just the words in the code can be enough to do something malicious. And so for me, it's like, if it can be done locally, then that's fine. If it takes away if it stops functionality, then it's not ideal, and I wouldn't be in support of that. I think it's one of the things that sets Excel apart from a lot of the other similar tools. And so, yeah, that's kind of my take on that portion of it. What do you think, Ty?
Yeah, I thought the Chrome OS thing was interesting to me, just because over the last couple of decades of having various computers, I get computers and then they get old and then they kind of lay around the house, and I often set them up like, behind me here is a TV screen with a computer powering it, so that it's a very like basic like media player, and then, also surf the web and all that kind of thing. But when I do that, having these various old computers lying around powering this screen or that screen, when I do that, it then opens me up to, okay, now I got to have like a version of Windows running and keep all that updated. And eventually that gets to be difficult over time as the computer gets older and older. And it's still fine for, surfing the web or, browsing some pictures or watching a video or something, even though it may not be the latest and greatest type of computer. So if I understand that update properly, that sounds kind of interesting to me, that I could just install this Chrome OS on old computers and use it for my overblown media centers at various places around the office and the house.
Yeah, the article did say that Google was intending it to be used for primarily from schools or nonprofits in terms of that sense, but it is available. It could be available to everyone, right? So, but to your point, everyone can find a need.
Yeah, that would probably be a better use of my old computers, is maybe donating them to a school or a nonprofit that could install Chrome OS, and then some person could be digitally enabled that isn't.
Yeah, awesome. Well, good. Yeah, the only one that kind of surprised me, but not really, was the fact that so many folks were dissatisfied with the technology in their environment. And I think that part didn't surprise me, but what did was that I think they said 47% of the folks that they surveyed were quite upset or frustrated over their systems or of the lack of systems and technology. But then the fact that there was like 27%, I think, that were willing to quit over it, and then to even know that there were some that were shelling out money out of their own pocket, so they could continue to work more efficiently and that kind of situation. So that one kind of surprised me, but didn't surprise me type of situation. But I do think it's one of those things, especially whether people are working remote or working in office, that companies should really think about how reliant people are on technology, and to make sure that they are up to date, or that they are, providing the right amount of technology for people to do their day-to-day jobs, because that would be the worst thing ever, is, to lose talented folks over the fact that you don't have technology support. So I think, Ty, you have our next discussion point.
Yeah, and I'm gonna share my screen so this will be my latest installment in this series of topics on craft spirits finance. And this one is titled People First. And for those who may not have watched our prior episodes where I've been talking about craft spirits finance topics, I've been really talking about the topic of what do you need in a finance or accounting department in a craft spirits company, in a craft spirits organization. And so the topic here is where I want to make my case of why I think it's important that organizations, and again, as I've said in kind of prior presentations, in prior episodes, is that I think that this topic could apply to small business as much as it could apply to a craft spirits company, general small business as much as a craft spirits company. And so, my case for why companies, small businesses, and particularly craft spirits companies should focus more on getting the right people for their department than on fancy tools or overblown process, is because that process, I don't believe that process and tools can actually replace expertise. And what process and tools do is they scale existing expertise. But when you layer on process, or you bring in tools or apps and you don't have the expertise to operate that, or you don't have the people in place who have the experience to know how to use it right, it doesn't go anywhere. You just spend a lot of money on installing a process. Like, you can hire consultants who put a process in place and leave, and you just spent a bunch of money, and then it's not going to really help you, or it's going to end up with results that are never quite right, even though you have a fancy process that was paid for by having consultants install it. Or similarly, if you're looking at the technology itself, an app or a software, you can have some kind of specialized software. There are some software packages that claim to be specialized or be the best for distilleries or breweries or craft spirits organizations, but installing those without people who actually could do that work without the app is, I think, is a recipe for problems. Because the way I look at it is that you want people in your organization that don't need the app to understand what needs to be done or to get the job done, but can use the app, can use the technology to do the job more efficiently or to do it better. That's the situation that you're in. And so if you have a limited budget, which most small businesses do, you start with the people, and then you layer in the cost for systems and process and extra technology later when you have a larger budget to have both people and are able to leverage the cost of additional technology. And one of the things that is quite frustrating for a lot of small businesses in our industry, and I made this comment in the last episode, don't try to build a process or build or install technology or install software designed for a $10 million company when you're only a $1 to $3 million company. And this observation aligns with that point, and that's that the cost of the higher end systems, ERP systems and things of that nature that are designed for larger companies, there's still, unfortunately, in the accounting world, there's still pretty high cost technology. There's so high cost technology, in fact, that my experience tells me that you can usually, in a small business environment, do the work manually without the automation and pay people for all those hours and still come out ahead versus the cost of installing the technology. And so typically, if you're less than a $5 million company, I would expect that to be the case. And I think what I've seen a lot happen in the last few years is that everybody loves automation, and a lot of accountants in particular, they just don't like to do the manual work. And so you get this kind of drum, this beat to automate things and to go ahead with installing costly systems. But if you actually do the cost benefit analysis, it often doesn't pencil out when you're that small. It actually works out that while it may seem annoying, somebody can spend the hours and get paid for those hours to just do some of that work manually, like in Excel, for example, than to use an automated ERP system that costs hundreds of thousands of dollars to install and implement and maintain over many years. So it's for that reason why I really advocate that small businesses focus first on having the right people who know how to operate the process, know how to get the job done manually as well as with tools, and don't jump to just installing tools and processes without the right people, as if having an app is going to mean you don't have to hire a more expensive person. That is a very naive approach that my experience suggests will cause the company problems in the long run. So when I talk about people first, what are the roles that you might have? Well, I call this a full-blown department, and actually in a very large corporation, there would be even more roles than this, or there would be multiple people filling some of these roles. But these are some of the roles that you might have all the way, by the time you get to, say, a $20 million organization, you might have all of these roles in some fashion. I wouldn't expect that a craft spirits company, most craft spirits companies are not really large organizations. Most craft spirits companies are small, businesses. So I wouldn't expect that you would have all these roles filled. And so I think it's helpful to kind of consider what these roles would be in a full-blown scenario, and then consider different combinations that you might have of these roles given your actual size, the actual size of your particular business. So in a full-blown department, the head of that, or the top of a department in a larger organization, would be a chief financial officer. But again, most small businesses would not have this role at all. And then you would have, you could have a director of finance, or even a VP of finance, or somebody whose primary role is financial planning and analysis, and they're kind of rolling up to that CFO. And what's interesting to note about that is that that role of financial planning and analysis, or FP&A, might be somebody who has an accounting background, or maybe not. It may be somebody who has some kind of financial analysis background in banking, or their corporate background where they really never did a lot of accounting, but they usually would have pretty good spreadsheet skills and have experience with working with a lot of data. And then your controller is really your head accountant. So that person, for sure, you would expect to have significant accounting experience, and be able to handle all of the potential accounting matters. An accounting manager is somebody who usually can handle most of your GL accounting and closing the books, but maybe just doesn't have the full experience that a controller does. Maybe if you have to follow what we call general accepted accounting principles, that accounting manager would need some outside advice on that if it got too technical, but otherwise they can more or less handle getting the books closed. And then you would have staff accountants, which are doing various components of the accounting, whether it's payable processing or invoice processing, accounts payable, or different kinds of general ledger tasks, or special projects or analysis, or various kinds of accounting compliance issues. Maybe they take care of your various tax returns, sales tax returns, and so on. So all of that kind of encompassed in those roles. And again, I wouldn't expect that all of these roles, that a small business or that a craft spirits company actually has all of these people. What we would expect in a small business or a craft spirits company is that they're going to compromise and combine these roles in different ways. And there's more than one way you can combine these different roles. So my examples are just possible suggestions, possible combinations that I think could work in a craft spirits company. So for example, if your company was less than $5 million in size, and if you watched a previous episode, the way that I'm talking about size of a company here is either by if the company basically has to operate out of its own cash flow, out of its own sales, then the size of the company we're talking about its revenue, its annual revenues, right? If a company is venture backed and it's building its brand, and it's actually, as I say, punching in above its weight, it's actually expending and has a size in terms of the number of people that maybe exceeds what you'd expect for its sales, then the size of the company, that 5 million we're talking about, may not be its sales. It may be its burn rate. It may be the total costs that it's incurring on an annual basis to run the business. But either way, you can have a way to kind of quantify the size of your company, which gives you some comparable perspective as to what you might expect in that size of business. So in a less than a $5 million sized craft spirits company, I wouldn't expect that you have a CFO or a finance director in that company, especially if you are doing this in-house. You might have a controller who is combined with an accounting manager. So you might have like a head accountant, and that person is both the controller and doing the accounting manager kind of role. And then they may have some assistance from a part-time staff accountant, or maybe they have somebody who is working another function in the company who is who is doing part-time staff accounting work for them. So I would think you might be looking at 1.5 FTEs or so for that $5 million company. Once you then get to like a $5 to $10 million company, I think you really do need kind of a controller. So you would need that more experienced accountant who is running the accounting department. At that point, you probably, if you go back to prior episodes where I talk about the different levels of needs that your finance department might have, or that you might want, different things your company might want from your accounting and finance department. And one of the things that I advocate that you'll want at some point is you'll want to do financial planning. You'll want to have a model, a cash flow plan that you're working through. I would expect for this size company that you have that, or that you at least have some version of it, the beginnings of it. And the controller here might also double as the finance director, and also and be working that model as well as working the accounting. And that would be reasonable within this size to expect to have that kind of person. That kind of person probably should be supported by a team of at least of a couple of other people, and it would be reasonable for them to have an accounting manager who really helps them get the books closed, and a staff accountant who maybe helps with a lot of the clerical or transactional issues. Once you get above the 10 million size, I could foresee actually having either a finance director or a CFO, and that role would probably combine into one person. It's unlikely you'd have both the CFO and a finance director at this size. And so your CFO in this case, if you had somebody called the CFO and they're doing some of the finance director job, they would probably be running the modeling. They would be doing the cash flow planning and the modeling and the business planning that I was talking about a few minutes ago. And then they would be supported by a separate person who is running the accounting. And that person in charge of the accounting would be a controller level person. It's unlikely that you would afford a CFO, a controller, and an accounting manager. So in this kind of combination, your person running the accounting would probably have to do the duties of both the kind of head accountant controller level work, as well as GL management and the accounting manager work. But I could foresee in this scenario that you could have 1 to 2 staff accountants, depending on their level and pay rates in this kind of department in a company this size. So you could probably have 3 to 4 people working, 3 to 4 FTEs working in a business of this size with this kind of combination. Well, who are the right people? Well, I mean, I'm biased on this issue, given that we run an outsourced CFO. We run a CFO advisory and outsourced accounting firm at TCA. But the thing that I would say, if I back up on the slides here, is if you go back to some of the things that I've said here, I say at less than 5 million, you're not really going to have a CFO or a finance director. And that'd be true if you're just hiring this in-house, because you can only have 1 FTE, and you're not going to pay the compensation of a CFO level person to then do the basics of closing the books and running the accounting that you would need in this scenario, right? So typically you wouldn't have a CFO or finance director here. But if you were using an outsourced firm, and certainly we're not the only one, and so the case for this is broader than just hire TCA. There's other firms you might look at for this point. But if you were using an outsourced firm, you can take that budget that you might have for 1.5 FTEs here, and you can cover getting the accounting closed, and maybe have a fractional person, somebody who on a part-time basis is at the table, who does have that experience at the CFO level. So using an outsourced firm allows you to take your budget in a smaller organization and get a broader breadth of expertise in your finance and accounting department, if that's something that you might be interested in. And the same thing, could be said here with the $5 to $10 million company. I said, well, for sure you would need a controller. Maybe that person's also doing some financial planning and modeling, but you're not going to have a CFO yet. Again, I would say you definitely at this size would have the budget with an outsourced firm to have some fractional CFO time, as well as some fractional finance director time and controller time. And really, you could have all the different levels and skill sets at fractional time within a budget that would otherwise only be, a couple people here, 2 to 3 people. And then in the 10 to 15 million, that ability to outsource really just gives you a lot of breadth possibilities. At this point, you really do have a budget to internally have your own finance director or CFO if you wanted to, but again, we're still only looking at 2 to 3 FTEs. And so you're going to make compromises here. Whereas if you used an outsourced firm that can provide you with fractional people at different skill sets, you could maybe not have to compromise. You could have people with the exact skills that are needed for each part of your finance department at this budget level. So that's really the case for outsourcing when you say who are the right people. But if you're going to hire kind of individual people, something to keep in mind is that you really should be looking for somebody with a 4-year degree in accounting or related for these roles. Now, if you have a larger department, where we talked earlier about, you might have a department where you've got some staff accountants. If you have a larger department, let's say you're in the 10 to 15 million range, and you have that CFO, finance director, and you also have that controller and accounting manager, and then you have 1 to 2 staff accountants. Well, in a department like this, can you get away with the staff accountants not having 4-year degrees in accounting or something equivalent? Yeah, you probably could, because you've got 2 other people who are highly experienced who would have had those credentials, right? So it depends, once you get large enough that you've got multiple people in your department, you can be a little more liberal with who those people might be. But I would be careful when you're a smaller size, being too liberal with who the people are, because while it may seem attractive because maybe they command a lower pay rate because they don't have the degree, that also means they probably don't have the credentials, experience, or expertise to actually be doing this job when they're the only one there to do the job and there's no one else to rely on. In this industry in particular, since we're talking about craft spirits companies, cost accounting and inventory experience would be a priority. And I think that's an important piece that a lot of people outside of the accounting world don't know, is that they think all of us as accountants kind of have similar knowledge bases or experience. But the thing is your 1040 jockey, the person who does your tax return every year for your family or you personally, 9 times out of 10, that person does not have inventory accounting experience, if they have business or corporate experience at all. There's no reason that person would necessarily have corporate or business accounting experience either. But even if they do, most of the accountants that are in that zone are working with service companies, sole proprietors, freelancers. They're not working with complex companies that are making and manufacturing products or buying and reselling products and dealing with cost accounting and inventory issues. So you got to make sure that you're dealing with accountants that actually have the right experience, because there is a wide diversity in the kinds of experience that accountants could have in this regard. Certifications such as being a CPA, CFA, CMA, they're generally not needed for these roles necessarily. They are an indication, in my experience, they can be an indication of commitment that people have to their industry or to their profession. But there's a lot of extenuating circumstances and great people who do not have those certifications that would be really good in your organization as well. So I think you can be a little bit liberal there if you kind of have some insight as to how you're going about that and maybe how you're rating overall experience against the certification. At TCA, we have a mix of people, and we've got people who have certifications and people who don't, and the talents run across the board regardless of those certifications. Now, one exception to this would usually be if there are significant gap compliance requirements or subject to audits. So if you've got a larger organization, you're going through regular financial statement audits by other CPA firms, it really makes the process more efficient for everyone if the controller has some experience in that world. And so typically, a controller for a company that is subject to rigorous financial statement auditing or has significant gap compliance issues, that would be somebody who has some public accounting experience, which would also typically mean that they are a CPA. And so, when you look at that department, though, that's interesting, right? Because if you go back and you think about this department where we have more people, I'm proposing here, you could have 3 to 4 people here in this department. I'm suggesting that if you had those kind of rigorous requirements, I'm only suggesting one of them would really need to be a CPA in that scenario, right? And it's not even the CFO that would necessarily need to be the CPA. It's that controller that you want them to be the CPA, because they're the ones that are going to be dealing with the auditors. They're the ones that are going to be making sure that you are in compliance with GAAP and going through all the detailed checklists and things that, again, you can do it without being a CPA or having public accounting experience, but it's going to be way more efficient if that person has been through that many times on the public accounting side. Okay. And the last thing I would say about talking about the people and who are the right people is beware of title inflation. So craft spirits companies are growing small businesses usually. And so what often happens in growing small businesses is we love our people and we want to give them cool titles, right? So we want to call them vice presidents or chiefs or whatever it is we want to call them. But the problem with doing that is that you end up creating awkward situations when you need room to grow. So if your company is growing very fast, right, and you go from being a $1 million company to a $10 million company to a $20 million company in just a matter of a few years, your internal team is not going to have the time to grow from being a $1 million accounting manager to a $20 million CFO in a matter of a few years. You're going to have to hire in experience. And that's going to be really awkward if you gave that accounting manager of the $1 million company the title chief financial officer, right? So I think that, and we see this all the time with small businesses. So I would say just keep that in mind, that it's, the more sophisticated operators who I've worked with who have, who maybe have started multiple businesses, they've learned this. And so typically that's why you see in a lot of the startup world, larger companies that you would think they should have a CFO, and you see people working like they are CFOs, but they only have the title of VP of Finance. It's because they know the company has made the strategic decision that they're just leaving room just in case, right? And that also cuts both ways. That can be unfair sometimes, or unfortunate to the person who's at that top end and maybe deserves that CFO title at some point. But that's what's going on, and I think that is good practice, because it does create awkward situations if you're not careful. And the other consideration when you're talking at the CFO level is, and I kind of got at this earlier, is that really at the finance director level, when you start talking about having a company that's big enough where there's a function that's primarily focused on modeling and cash flow planning and working with bankers and investors and that sort of thing, that person may not come from an accounting background. And so what you see in the CFO ranks is you see CFOs that are accounting or operational CFOs. And that's typical at TCA. That's what we are. We're accounting and operational CFOs. We come from an accounting background. And I think we're particularly well suited in the small business environment to work with small businesses for what they need. But there's a different kind of CFO, which I'd call the investment banking CFO. These are people who come out of banking. Sometimes they come out of really high-end branded investment banks, they could be from Merrill Lynch or Goldman Sachs, or some of these kind of sophisticated sounding organizations, and they are sophisticated organizations. But the problem is that their primary expertise as an investment banking CFO is raising money and helping secure deals, maybe working with bankers, maybe doing some financial analysis, but they often don't have the detailed knowledge of how to get the accounting done. And so an investment banking CFO, in my opinion, and again, I'm biased as an accounting operational CFO, but an investment banking CFO, in my opinion, is best suited for fairly large organizations. When small businesses bring in investment banking CFOs, I'm often just roll my eyes or shrug, because it doesn't make a lot of sense. It doesn't help them. It adds a lot of cost to their overhead structure that is not going to be super helpful to the job at hand, which for a small business in the craft spirits world anyway, is typically making sure you've got your cost accounting right, making sure you're managing cash flow, making sure that your departments know what they're spending. Those are accounting operational issues more than investment banking issues. So that's something to just keep in mind, is that you'll have all kinds of CFOs out there that may want to work with your organization, may work with your business, but consider what kind of background is actually important for your business. And just because they come from a really fancy big company or a bank or something of that nature, that doesn't mean they're right for your business. Okay, well, those are all my thoughts and biases on this topic. And I turn it over to Tammy and Charlie. And I think that I'd invite them to jump in at any part of this. You know, they could challenge or discuss my thoughts on whether it is people first versus technology and process, or my thoughts on what the combinations of people could be for various sizes, or even my thoughts on who the right people are. Those are all different things that you could have opinions on. I'll let you two jump in and wherever and however you want to discuss that.
I love this. This is probably my favorite presentation that you've done so far, Ty, on that, just because in terms of the discussion about people first or technology first, I think the way that you laid it out was really quite well done. Not to give you too many compliments on that, but at the end of the day, when you're building a company and you're looking at the infrastructure, what you should be using, and it is really good, to have knowledge of what you're actually trying to obtain through the system. A great ERP system or a great, production system, manufacturing system, all those things are great. However, you need to know the ins and the outs of what you're trying to do, because you may have this great, powerful ERP system that you're utilizing and not understand what it is that what it's doing, or if there's an error, like how do you actually fix it, or how do you set it up? Because a lot of times companies, especially ERP systems, will kind of come in with this cookie cutter system and they'll implement it. And then you're trying to force your production runs or your accounting process or all these other different processes to fit within that system. And that can be very, very challenging if you don't have the right people at the table who actually understand what the system should or should not do, or what kind of tweaks you need to make with the system and or to your overall processes. So I do think that the people first in that particular scenario is needed, because you want to ensure that you have the knowledge base to design what your needs are going forward. And the other thing I wanted to kind of add to that is this discussion is crucial to have in the beginning stages of a company, because you don't know what you're going to be doing in that and how you're going to be growing. So having those different kind of combinations and the strategy of who should be at the table is really great to kind of, because it will evolve and change as you kind of stated, as the company grows. So I thought that was really a good kind of reminder for myself, but also just a great discussion point when you're working with companies to kind of go through that process, because having the wrong person, whether it be the wrong person in terms of the way to experience or not experienced enough, or the wrong title and the wrong responsibilities, not understanding the software or the system, or understanding to be able to do it outside of a system, that can be very detrimental to an organization when they're growing very, very quickly and then jumping over some of these hoops and kind of going to different things. And then you can't unwind it. Unwinding is very, very challenging to do for any organization. So I think that this is something that I would encourage businesses to do some planning in advance. And I think I probably haven't said it as much in this podcast, but I used to say it quite a bit in our sister podcast, Profitless on Purpose, a little plug for them. But planning is crucial for all organizations of any size. And I do think it's even more important to do when you're growing, because you're trying to be flexible and grow with what the situation is happening and what could potentially be what it could be growing into. So this was great.
Yeah, I just want to second that. Not to kind of parrot everything you're saying here, but I've worked with these owners who will say, they'll say seemingly reasonable sounding things like, if I'm removing steps from a process by putting in some new system or ERP or program, how can I be making it harder if I'm taking away steps? And that sounds at first like a pretty realistic question to ask, because anything that you do less clicks or whatever to do becomes easier. But I think about it like riding a bike. Let's say you're trying to ride a bike and you're having trouble. If you switch up to a motorcycle, you no longer have to pedal because it's automated. It's part of the machine. And so you have less things to focus on. But we know, as professionals, that you wouldn't put a kid who's learning how to ride a bike on a motorcycle, even if it takes some of the steps out of the process, because as you're changing the equation, you're taking out a step you were having trouble with, but you're now adding in a lot of other things. That's an admittedly extreme example and completely intentionally away from accounting to make it relatable. But the same thing happens in accounting all the time, where somebody puts in this ERP, it does a bunch of things. They don't know why or how it did that. And they get 20, repetitions deep into a problem that now, like Tammy said, has to be unraveled. And it can be very difficult. And so, yeah, I really want to second that whole idea of people first. And I think also this is more maybe a personal note, but a lot of times what I've seen is that people will put in an ERP to solve a problem that actually has a more accessible solution. And so they'll look at their current ERP and they'll decide it doesn't work. And they'll decide they must need this new one, which admittedly does the thing they want. And so they'll jump to the conclusion that we need that, and they'll just start implementing it. But they never pause to say, well, was there maybe a compromise somewhere in between, perhaps a summary that we could have used or some other tool that would have gotten us to the same end conclusion we were going for, but without all of the problems introduced by the new ERP potentially. And so it's a very practical thing that I just see people struggle with, and it's hard for them to see why you wouldn't want to take steps away from something, but it's not always as easy as less steps equals better. So yeah, I think it was a really good topic to discuss. I think it's very relevant, and I see it happen in real life all the time.
And I just thought of something else to add to that too. And this is coming from my auditing background, which I spent almost half of my career doing, is I've seen a lot of ERP systems and have used by various different companies. And I have never met a person who says, I love this ERP system, and or that the ERP system solved all my problems with whatever, fill in the blanks, with supply chain, with, forecasting, with whatever it may be. So I always want people to consider, when you're really looking at the ERP process and what your needs are, to really to look at what your actual needs are and what your processes are, to do that before you go off and buy. And if people complain about a ERP system, sometimes it could be to the point where, in Charlie's example, which is great in terms of maybe you don't know the system, or you don't have to pedal anymore. So you're doing this instead of doing that, and you never learned how to pedal. Really understanding the system and understanding the software could actually be beneficial and helping, ease some of those frustrations, which now we're coming full circle to the article we talked about in terms of technology, but understanding the technology that's being used and understanding and making sure you have the right one is going to be crucial for people who are working in the system. Because you don't want those people to be quitting based off that survey because they didn't utilize the ERP system, or because they had the wrong ERP system, or because you can fill in the blank on that. So just to kind of call out on overall ERP system is it's not usually the solution. It's not the fix, I guess. It's a method or a tool to utilize. But if you're thinking that it's going to fix something ultimately in terms of the overall organization, that's probably not going to be the right path, in my humble opinion.
Those were great points, and thank you both for your feedback on that. And I love Charlie's analogy of going from walking to riding a bike to riding a motorcycle. I think that I'm going to think about how I might use that in some of my discussions. All right, well, I'll kick it back over to Charlie actually for our next article here.
Cool, thank you. So yeah, I've got an interesting one I thought might fuel some good discussion. So it's from a source called The Hill, which I'm not familiar with, so apologies if it's not the best source, but the article is called How Landlords Are Evading Taxes and Fueling the Housing Crisis. And so some kind of background on this is that apparently opaque ownership laws have made it easier for property owners to avoid paying taxes. And that's compounding with a national housing crisis that's fueled by inflation and a shortage of low and moderate income homes. And the author of the article has kind of honed in on what they believe is the core issue, which is that LLCs, limited liability companies, for those who don't know, are increasingly becoming the owner of record of various investment properties. And what the author of the article has found is that there's a linkage between LLC ownership and things like tax foreclosure and home abandonment and whatnot. And so it goes into some of the reasons why. It talks about a lot of times foreign investors have money that they're trying to hide from their local governments, and so they'll go to New York and buy a property as an LLC so that they can get this anonymity of assets and basically shield their assets from that foreign government. And so, but the kind of the downfall of that is that in a lot of these cases, what ends up happening is they'll do things like they'll have tenants, they'll take in the rent, but then they'll not pay the property taxes, incur a large debt, and then ultimately just abandon the property, which really just takes this usable asset of the home and takes it off the market because now it's stuck in tax foreclosure. And so we were talking about a little bit before the podcast where different states have different laws on the books that govern how much information is shared about LLC's ownership. And I think that, it's become kind of a strategy to some people to use tax foreclosure in their real estate practice as an actual business option. And so it just seems not intentional. And, the article looks at, well, that happens because the LLC owners are anonymous. But from my perspective, if you are a state, let's say you're Florida and somebody starts an LLC in Wyoming and then comes and buys property in Florida and doesn't pay the tax, and Wyoming protects that owner's identity so that Florida can't chase that person for money. I would basically say that Florida should be considering whether or not it allows Wyoming LLCs to purchase property in its state if it's ultimately not able to collect on its own taxes as a result of allowing, Wyoming LLCs to purchase property. But we haven't seen those kinds of restrictions put in place. So it either the legislation hasn't caught up to the issues, or B, maybe there's something more to it that I don't understand that, makes it okay for that to happen. But from my perspective, it just seems like a very strange, way to do business, to basically go into a property knowing you might foreclose on it. And so just doesn't seem intentional. I want to get your guys' take on whether or not you thought that, that this is the intent of those anonymity laws, or if, the system is being misused.
Well, it seems doubtful that this is intended to work this way. But I think the other curious thing about it is, the circumstances of which the property value itself would be so low compared to the taxes that are racked up on it, that it made business sense to rack up the taxes and then use your anonymity to just walk away from it and leave, based on back taxes, right? I mean, and so I think it may be something where there's not a huge, that there was never an intent, but there's also not a huge incentive to try to fix it, because at the end of the day, if people are forfeiting their properties for these back taxes, governments are being made whole anyway. They're getting the properties and then they're auctioning them back off and getting the cash or whatever. I guess, it's not an efficient use of government, and it probably isn't, they're probably not getting best prices or whatever when they do that. So I don't know. It's interesting. I think there's more to the numbers there to kind of consider in terms of what that actually means and who is actually winning on this. I bet there are some scenarios where the governments are actually winning, where they're getting properties that ultimately have significant value compared to the almost arbitrary value of the taxes that haven't been paid. So yeah, I think all of that would be interesting to kind of consider in the totality of the analysis. But for sure, I don't think anyone would have set this up intentionally for people to just not to avoid knowing who the owners of property are.
Yeah, and I think to your point, Ty, I do think there are probably some benefits that the state may be getting in terms of the value of the property that they can now own and then resell or do things. And I don't know if I missed it in the article, Charlie, but does it say anything about in terms of the residents that are either renting these properties or if they're not being, are they being kicked out during this whole issue with not paying the taxes and hiding the ownership in LLC? Because then I see that there is a much bigger issue for me on that part in terms of this overall conversation.
Well, it talked about the tax foreclosure taking homes off the market, which indirectly drives up, makes it harder for the tenants to ultimately get a place because those places are now just held in tax limbo. And so I think it mentioned that, but it didn't go into much more detail
Yeah.
about the resident side other than that.
Yeah, because I think that could be, a much bigger issue in the states that these housings are in. If they are being foreclosed on or pulled back from the government at the time when there's rental residents that are living there, right? And then I think that it does become much of this very tricky situation all across all fronts on that point. And I do agree with Ty. This probably wasn't intentional the way that the laws were set, but I do think that being that it is kind of this hidden LLC and our ownership group and all this kind of stuff, that does people may be taking advantage of the situation of that in that front. And so, yeah, it's not the greatest kind of situation here. So I don't know. I really don't like this one, especially in terms of because I think about the placement of the people, because that's outside of their control. If I'm renting a house or an apartment and I'm assuming my rental payment's going to pay for all those things, and then I get a letter saying, by the way, the property is now owned by the state and you have to get out because of failure to pay taxes, and I have no idea, like it makes it very difficult on that side. And that's in general with renting, but with this tax kind of loophole and stuff or issue, that I think it causes an even more bigger problem.
Absolutely. And I think it becomes part of an overall strategy for them as well. Because if you think about like them, if you're a landlord and you say, I'm just going to let my property go into disrepair and try to collect rents on it for as long as the tenants will allow it. And it's like that is another way to basically encumber the property to take out money. And if you do enough of those ideas, you can get the property upside down enough to where it starts to make financial sense. Now, I'm not saying most deals would do this and they shouldn't, but I think it's just a part of a bigger picture that they're using. And it seems like the more solvable part of it, at least when you look at those two issues side by side. But yeah, do you have another article we can talk about, Tammy?
I do. So we've talked a lot about raising prices in the past and how often an increase in price is a result of an increase of cost. But a recent article from CNBC titled "Disney is Raising Prices, but this time don't blame inflation" really caught my eye. Earlier, Disney announced that they are increasing the subscription fee of both Disney Plus and Hulu. They also mentioned that a price increase at the parks could be in the works. Why? One may think it could be due to overall increases in cost of labor, gas, material. However, Disney has stated that it's due to the strong demand for their products and services. The popularity of its products can support higher prices. The CEO has been quoted in saying, "It is all up to the consumer. If the consumer demand keeps up, we will act accordingly. If it is softening, which we don't think we're going to see, then we can act accordingly as well." The rationale that's being shared could be unsettling, especially to the price conscious consumers who may accept higher prices when it's linked to higher costs, but often avoid buying things that are considered too expensive. The article also stated that Disney has intentionally capped attendance at its parks, primarily to avoid overcrowding during COVID, and which actually improved customers' experience. There are also products available to help bypass lines that people who are attending to the parks could purchase, so they can kind of jump ahead of the lines. And both things could have, in my view, could have helped explain the increase in price, especially in terms of the software cost of doing those apps that help people go into the lines, and the fact that you're reducing the amount of people who are in the park at a certain time, so you have more cost to spread over the people who are attending. But that's not how it was presented in the article. So the article may be a bit biased, but I wondered what your guys' thoughts were on increasing prices because you can approach versus justifying increase in prices because you need to.
Well, I guess I look at this entirely on the other side of it. I think the only justification for raising prices is always because you can. If you say it in reverse, is the fact that your costs as a business go up justify you raising prices? I mean, you might try to use that as a way to get a higher rate, but in the end, in a market economy, which I believe in, it doesn't. The fact that your costs go up doesn't automatically give you the right to raise prices. The only thing that's going to provide you with the ability to raise prices is because you can. So my answer to this question is very simple. never has anything to do with cost. It always has everything to do with, because you can. Even all the companies who are raising prices due to inflation, it really boils down to they're raising prices because they can. Inflation is a nice marketing excuse to throw in there, and not just an excuse, but true. And I think this is particularly true in a situation like Disney, because what Disney provides is not something that is an essential need. So at the end of the day, for sure, they can and should be raising prices based on their expectation of market demand for their products and services, and that is the only reason that is the only governor of their price in my worldview.
Yeah, I've got to agree with that. I'm pretty biased on it as well. I mean, for a long time, I worked for a company where the whole idea was around repricing, and a lot of that idea was getting the most, making the most effective use of your inventory by getting as high of a selling price as you can on it, and is a very automated approach to that problem. But if you think about it, this issue is really just that same question of, should we charge more if we are able to? And in my opinion, that's the whole reason that you would do the thing that you're talking about doing. I mean, if you're going to sell books online, you're trying to do it so that you can get as much money through that activity as you can. And if you're running a Disney theme park, the same is true. Now, it's a little bit more nuanced in my eyes than whether or not just because you can, because ultimately they have to be thinking about whether or not the demand is actually there, because a lot of times you can raise a price and some people are willing to pay it, but others aren't. So even though you've raised prices, you end up with less revenue because people get out of that, stop using your service. And so there's some nuance to it that I know you both know, but it just like, as I'm thinking about it, that would be the other thing to look at. But if they're able to, if ultimately Disney can become more profitable by raising prices and people are willing to pay it, then that's the correct price, the one that people are willing to pay. And so, and like you said, yeah, it being a luxury thing also helps with that. And I think some of their argument of it's not inflation, it's because we are able to, is actually not as obvious as it seems, because I mean, part of the reason they're able to is because at this point, everyone's used to paying more prices for everything. So when we learn that Disney's ticket price goes up, we go, oh yeah, like everything else. And so you can say that's not inflation, because you can say, oh, on Disney, I'm so good that that's not inflation. But that's the reality for the families, for whatever, who are looking at buying those tickets, is that's how they're going to view it. And so, those are my thoughts on it.
And by the way, I would say not everything in our society has to be subject to market economics. And I think Charlie would agree with this, right? The Water Bureau, the, basic, the food commodities and things of that nature, pharmaceuticals and things of that nature. Some of those things are subject to more market economics than I think they should be, actually. So, I think it depends on the category of the thing we're talking about. But Disney, for sure, it's market economics. They're not an essential service that necessarily needs market intervention.
Yeah, I think you guys have great insight on that. And I think one of the things that when I was looking at it is I spent a lot of my career in those food kind of essential type of categories, where when you did take price, you had not to only explain it to the store, the customers, but then they would in turn have to explain it to the consumers, because in that particular case where there's so many different alternatives, it is like you have to justify the price increase, because a lot of people are a little bit, they're more sensitive in terms of that, and want to make sure, like, if I'm paying more, there's got to be a reason why. And so it is more of a marketing type of situation, and hopefully you can still take price and people will still be loyal to the brand and want to buy it. But you're right, I mean, with Disney, it is a luxury item. It has continuing, even the article said, like, it's been increasing in price over the decades, and it hasn't reached a cap yet, right? But it is an experience, and it's a luxury item for families to decide if they want to participate in it or not. I do think it's an unusual approach, because I do think most people have blamed or tied their raising of price to inflation, even though they probably didn't need to justify it, but they did anyways. And so, but to what Ty said at the beginning, people, you can only raise prices to the point where people are going to want to pay for it. And it was just, yeah, it's a little bit shocking to be so bold about it, but it is probably the truth in most cases. Most companies probably are taking price because they can, and it could be tied to inflation. It could not be, but it is what the market will bear. So it's just it's an interesting kind of viewpoint.
I think Charlie's comment that, undoubtedly an inflationary environment is what empowers them to some extent on this. And so my view of, the reason why, to your question of, why would they be so bold in their statement on that point? I think the audience for that is investors. I think the audience for that is the securities market, because, the meaning behind that is, look, we've got a really great brand, and we're able to raise price because of the strength of our brand and our business. And, and that's a really great story when the audience is not the consumer, but the audience is the investor, the stockholder. So I suspect that's why they're taking that approach.
Well, one more thought I was just thinking about as you were mentioning that is that the other factor here is, at least with specific to the streaming services, is I know Netflix is kind of right now making a bunch of really bad decisions when it comes to subscribers and whatnot in terms of their policies. And so to no action of Disney, if Netflix bleeds subscribers, those people are out there looking for new streaming services. They end up signing up for this, and Disney didn't even have to do anything to justify a higher price. All they had to do is let Netflix do some dumb stuff, lose subscribers, and those guys are ready to go. And so I don't know if that's part of the reason, but to me, that's a factor.
Well, and I think that's 100%, because if you look at it too, and we've talked about this in previous articles, all the stuff that Netflix is doing in terms of increasing their prices is it's in the media everywhere about why are they doing it? Should they be doing it? Is it just a money grab? Is it, what are they going to do with the extra funds? Are they going to really invest in the infrastructure, invest in the product, or the platform and what they're showing? And Netflix is scrambling, trying to come up with all this justification, be like, hey, you guys, I'm doing this for you. We need more money to give you better entertainment and all this stuff. And it is kind of to the, which is probably again why I do find this so kind of like, it is a great article on that, because Disney's like, I'm not messing with that. We're doing it because we can. and the funny thing is, the response is probably going to be, although probably not with me, because I'm not a subscriber to either of their platforms, but people are going to probably pay it and not really ask more about it, because they've said what it's for, and that's fine. And because they do love the product and love the stuff that they offer. So it's two different approaches. That was a great comparison, Charlie. Thank you for bringing that up, because that is such a great comparison between two companies that are doing two different things when it comes to subscription revenue, and which approach will be successful. And I think most likely, even though I am not a big fan of this particular statement of how they came across it, but I think you're 100%. It's probably going to land better with folks than what's happening over at Netflix.
All right, everybody, that's going to do it for the None of Our Businesses YouTube show and podcast for this week. Please tune back in again next week for more business updates from an accountant's perspective. Not just one accountant, 3 accountants. And also check out our sister podcast, Profit on Purpose, where they're talking anything and everything relating to the nonprofit space. Thanks, everybody.